So there's my Thinkorswim, and we're on the E-mini. This is in the simulator. We're on the Analyze tab. We start everything on the Analyze tab. It's just much more convenient. Normally, this is the risk profile when you get there. So this is the risk profile screen. This under the Analyze tab on Thinkorswim. We're going to simulate trades by clicking this button. This will bring us to the options chain. This is also something you're familiar with if you're under the Trade tab. You can go there to All Products, and then you could put in your favorite product. We'll do that. We'll show you both ways. Is the ES, all right? So it's the same screen, but this is under the Trade tab. We like to put it under the Analyze tab because then we can set it up and stage it and then figure out what to do from there. Get our trades exactly the way we like, and then we'll blast them off into the market. So we'll go to the Analyze tab. That was the Trade tab, same basic view. Here's under the Analyze tab with the Add Simulated Trades. You get this view here so you can see all the futures contracts that are available. We're only interested in the June contract, which is ESM. M stands for June expiration. Don't ask me why, but that's the letter they chose in 2023. And that's all you can really trade here anyways. You can't really trade these others. So let's close that up, and we'll choose tomorrow's expiration, which will be Tuesday. Today's Monday, and we get our options chain. We'll make this a little simpler, so we'll choose a smaller amount of choices so it'll be easier to see. 14 is a little bit too small, so we'll make it, I don't know, 25. All right, so now we have 25 total rows. Okay, first step is that we're at the money and we want to create a Batman. We want to create both a put fly and a call fly. So we're going to do it on both sides. And it's really simple to do. I just go way out of the money, maybe 10 strikes or so. Now, there are a couple of things that you have to think about what you're going to, when you put on one of these trades. The most important thing is to think about, well, what is your max position size? What is your normal position size that you would enter the market with? Let's say $25,000 or $10,000 or $5,000, whatever it is. We'll assume that you have a small account, let's say $10,000. And so we're only going to put on a single position on each side. And we want to make it a width that we can afford. Now, on a $10,000 account, you can probably afford 1.5%, maybe 2%. Let's say it's 2%. 2% of 10,000 would be $200. So I want to put on a trade that's not going to cost me more than $200 per side. So the other consideration is that we want to put on a trade that has the proper risk to reward. Now we use a technique called the 10% rule. And so whatever the width of the trade is, we put on a debit that is 1/10 of the width. So with a width of 20 wide. That's 20 wide per side on the butterfly. So if you looked at it in total, it's 40 wide, but each spread is 20 wide. The debit that we would expect is no more than $2 because that's 1/10 of the width. Now that would be for a 20 wide. We'll do a 30 wide as well. So the first thing we do is put a butterfly on the put side, and then we're going to buy a butterfly on the call side. So we buy it on the put, buy it on the call. And we'll adjust these first before we decide to send them to the market. So there they are. I don't know if they were in the right position. They're obviously not the right width. I have to change all that to get what I want. So the next thing to do is to make them the width that you want. All right, so we'll start with the put, the guy on the left over here. And we know that it has to be, we want it 20 wide because 1/10 of 20 would be 2, and we decided that $2 would be the appropriate size for our account. I'm making this stuff up. So let's say that you had a bigger account and you might decide that a 30 wide and having 10% of that, $3 or 300, well, on the E-mini, it wouldn't be 300, it's half of that. It would be 150. Let's do that. Let's talk about the E-mini and the difference between the E-mini and the SPX. Now, the SPX has a multiplier of 100. The E-mini futures has a multiplier of 50. Now, what that means is that each trade, when you see the dollar amount for that trade for an SPX, it's just like stocks, 100 times, like 100 shares. So if it says that it's worth $2, then you multiply it by 100, you get 200. On the E-mini, it has a multiplier of 50. So if it said $2, you have to multiply that by half. It would actually be not $200, it would be $100 because it's half. So let's just assume then we have a $10,000 account. We're going to put on a 30 wide trade. So that's $3, 10% of 30 wide. But we know that $3 with the E-mini, it's actually not 300, it's half of that, it'll be 150. Does that make sense? So each side will have a debit of 150 or less. All right, now we have that established. So we're gonna make them 30 wide, is what it really comes down to. Let's start off with, see, 3905, and then 3965 would give us 30 wide on that side. And see, it's telling me 360. That's more than what I wanna pay. But I'm not worried about that yet. I wanna set everything up first. So this would be 3 wide, and this would go to to 55. All right, and obviously that's way more than what I want. All right, so now we have to adjust these. Let's start with the put. We'll just go take each leg and just move it out one strike. That should bring us to $3 or less. Let's try that. One strike. Not enough. One more strike, if that'll do it. And if it does, we need to do 3 strikes, we'll do 3 strikes. All right, that's good. So that $2.95 is a good price for that. Now let's do the call side. This call side has to go way out. So let's put it out like 5 strikes for each one. 1, 2, 3, 4, 5. Okay. And then this one. All right. Now that one's at the same price. Good. We got them right on the button. So there's our 2 trades. And this would be our Batman that we would put on for the next day.